Hey guys, I'm 𝗥𝗙𝗙𝗪𝗧𝗏 from 𝗙𝗏, and today I'm going to be talking about, is Baidu worth the risk? So in my last video, I analyzed a few stocks that you guys suggested, and one of the ones that I checked out was this stock Baidu. And what I noticed from my peripheral search was that the fundamentals of this stock were incredible. But before we get into these fundamentals and what is Baidu, I want to talk about why that I'm interested in investing in China and how I imagine Chinese stocks fitting into my portfolio on eToro. If you want to go find that portfolio, just go to eToro and search 𝗥𝗙𝗙𝗪𝗧𝗏 and you can see all the positions in my portfolio there. First off, the first thing that you need to get your head around with regards to Baidu or any Chinese stock is, why are we interested in investing in China? Well, Baidu's financials actually demonstrate this pretty well. Baidu has 50% gross margins and 15% net margins. So on everything they earn, 15% of that is pure profit. On top of this, they have amazing historical growth and a price to earnings ratio of 10. Having fundamental data points like this make the stock insanely attractive on its own. If this was an American company right now, this stock would easily have a price to earnings of 20 to 30. But it's not an American company, it's a Chinese company. A lot of people point to the CCP, or the Communist Party of China, as a reason that all the multiples in China are extremely low right now. However, I want to give my short take here, because Chinese companies had amazing multiples pre-pandemic. However, during and since the pandemic, these earnings of these companies did really badly. They were still growing in a lot of ways, but they weren't growing fast enough. And the reason for this, in a sentence, I believe, is that the Chinese Communist Party prioritized public health over economic health. I think the biggest question here is, if we didn't have things like the war with Russia and Ukraine that China are kind of involved with, and the rising tensions with Taiwan, would these multiples be any different? Would they be much higher? I actually think no. The reason for this is, pre-pandemic, Baidu had insane growth from like 2013 to 2018. In 2013, on a last 12-month basis, they had 40 billion in revenue and 10 billion in earnings. In 2017, they had 27 billion in earnings alone. That means in the space of just 5 years, they almost had as much in earnings as they'd previously had in revenue. But then just 1 year later, the engine stalled. Revenue grew from 104 billion to 108 billion. That is nothing. And in the past, when we've had little revenue growth, we've at least had big earnings growth. But this year, the earnings dropped from 27 billion to 2 billion in the middle of the pandemic. Can we just imagine for 1 second what would happen to Apple, Google, or Nvidia if they had earnings like this for just 1 year? You wouldn't need any excuse. You wouldn't need a war with Taiwan, rising oil prices, or anything like that to justify their declining share price. Is it hard to imagine the things that people would be saying about the US government and how it is managed today if share prices were to decline by this much as a result of earnings declining? So this is why I am interested in China, because they did have a significant earnings dip, but they are already recovering to pre-pandemic levels, and I believe that we're going to start seeing the same growth that we were seeing before the pandemic. So what you have is a country with more or less the same building blocks for growth as the United States, but attractively priced. But perhaps for you guys, it might make sense to understand that the bigger reason that I'm interested in investing in China is for the sake of my overall portfolio. Like I said, guys, you can go check out my portfolio on eToro. However, I do have a second portfolio offline that you should all do, which is where I just put a bit of monthly money into the S&P 500. And because I do this, I have a huge exposure to US big tech stocks. The amount of money that I have invested in the S&P 500 is about the same that I have invested on eToro. And while every investment I make, I want to stand on its own, I want it to be, I want to invest in the absolute best companies I can find, I also want to have a range of off-road vehicles. To put it another way, I want stocks that are going to do well in different market environments. Some investors go super heavy into portfolio theory and trying to make sure that they have 100% uncorrelated stocks in their portfolio so that they do well always. I prefer instead to take a more relaxed approach to portfolio theory, which is where I try and imagine that my stock portfolio is a garage of cars. Now, you want your most expensive car to be the car that you use every day. You want this car to be reliable, you want this car to last a really long time, and this car is, for me, the US S&P 500. But the S&P 500 is not going to do well all of the time. And there are going to be times that you want to go and drive to different market environments that are not suitable for your main car. So you want to have different cars in your garage for different conditions. Now, up until now, Alibaba has been my off-road vehicle. I bought it when it was favorably priced, and when it kept getting cheaper, I bought some more of it. So I've gotten it at a really good price, and its margins are doing well, its growth is coming back, it's performing exactly as I want it to. But you have to understand, Baidu could be really, really fantastic, and I'm not just gonna sell my car and buy a new one. And I also don't want two cars in my portfolio, giving me twice the work, taking up 2 spaces in my garage that both offer the same sort of off-road terrain. Ultimately, the big reason that I don't want to do this, that isn't a metaphor, is the fact that I don't want to be going through 2 sets of financial statements 4 times a year. I really like to get to know my stocks and understand them, and if I've got 2 Chinese stocks that both offer me more or less the same market, then basically I'm just giving myself twice the work for very little extra benefit. So for Baidu to show up in my portfolio, it needs to be meaningfully better than Alibaba in 3 simple ways. Now, by the way, guys, there are investors that like to take this approach, huge, big, successful investors like Peter Lynch. It's just not the approach that I really like. Right now, if you take out my crypto and US dollar out of the portfolio, I have around 11 stocks, and really I prefer to have 10 or less. So if anything, right now I want to be losing stocks, not picking up more. And as you can see in the portfolio, I have quite a good mix between UK stocks, German stocks, Chinese stocks, and US stocks. So for me, in order to replace Alibaba with Baidu, it needs to be meaningfully better than Alibaba in 3 simple ways. Number 1 is if Baidu had an attractive moat that was meaningfully bigger than Alibaba's moat. You may think it's quite hard to measure one company's moat against another, but to be honest, I think it's quite easy. For example, Coca-Cola have a much bigger moat than Google. The reason I see Coca-Cola have a bigger moat than Google is because when there are identical products to Coca-Cola on the shelf, or products that potentially even taste better and are cheaper, people still go to buy Coca-Cola. However, if people can search for things on the internet and get better results faster on other search places than Google, people will go to them very quickly without thinking about it. And if you're thinking, I don't do this, well, you search for songs on Spotify, you search for products on Amazon, and you search for random questions now on ChatGPT. And all of these things are taking revenue away from Google. Now, Amazon.com have a much bigger moat than Apple because they invested billions into a network of warehouses in every country they operate in. Any company wanting to match Amazon in terms of profitability in e-commerce need to match their billions of dollars of investment into infrastructure, whereas Meta did not require the same level of capital investment in order to compete with Apple in VR headsets. This leads me nicely into point number 2, which is they need to have a clear path to growth. For me, the stock in my portfolio that has the clearest path to growth is Greggs. Greggs is a UK bakery, and it is one of the fastest growing bakeries or food businesses in the UK right now. The way that I know that they have a clear path to growth, and a lot of it is because 1, I know how good the business is right now, but they have only 2,500 stores, which may sound a lot to some people. I know that some people think that there are too many Greggs because on some high streets they have 2 to 3 shops, but if you compare this to a worse business, a worse food coffee business in the UK right now, Costa Coffee, they have 15,000 stores. So there is a huge amount of space for Greggs to grow right now. Greggs could easily triple the amount of stores and not come close to how many Costa coffees there are. So this is a really simple way of identifying a clear path to growth. So whenever I invest in any company, I want a very clear path to future growth. Now, number 3 only generally comes in if 1 and 2 are both there, but number 3 is price. If the qualities are more or less identical, then I want to have a really good price. So guys, there it is. Those are the 3 things that Baidu need to outperform Alibaba on for me to add it to my portfolio. And if you want to go check out my portfolio, just go to 𝗢𝗙𝗚, search 𝗥𝗲𝗰𝗪. So first of all, what is Baidu? Well, Baidu is actually, and I didn't know this when I started doing the research for this video, Baidu is actually China's version of Google. To be completely honest, I knew that China had their own version of Google. I just didn't know it was a publicly traded company. And when I saw Baidu's logo of the paw, I thought it was actually going to be some sort of like pets food company or something like that. And China was potentially going to have some booming pet industry. But actually the paw is a symbol for tracking. So yeah, if you didn't know that, the paw in the Baidu logo is a symbol for tracking, which is loosely tied to searching, so it's a metaphor. I thought Baidu might do other things. They do a little bit of cloud computing, but yeah, basically the entirety of the business is the search engine, a little bit like Google for Alphabet. However, Alphabet do have things like YouTube. You've got to remember, they do have some other huge businesses. In terms of moat, Baidu's moat is absolutely fucking huge. And I'm sorry to swear, but this is probably one of the biggest moat companies that I could ever imagine. Basically, China are never, ever, ever going to allow Google search to be in China. So they have absolutely zero competition from the outside world, and inside China, basically no companies are trying to get into search. At least maybe you can help correct me in the comments. I only use ChatGPT to suss this out, but when I asked ChatGPT, it was saying that the closest competitor is WeChat, and I've used WeChat. It's a glorified version of WhatsApp. It's got some sort of social media features in and some payment features, but basically WhatsApp is WeChat is basically WhatsApp. So if that is the closest competition Baidu has to search engine, then Baidu has a complete monopoly over search in China. The next point, however, is growth. For Baidu, I see no clear route to growth. They may absolutely grow. They are investing in AI in Germany and the UK. Don't really know what they're doing, so I can't price it in at all. And the thing is, all the other countries use Google, I believe. They may have their own search engines, but it's going to be very unlikely that the search engine of another country is going to be Baidu. I do know that there is Baidu in other countries like Japan and stuff like that, but it just doesn't seem to be very big. I certainly can't see this doing well overseas. Baidu does have a cloud computing business that could do well internationally. However, what I will say about cloud computing as well is it sounds super high tech, doesn't it? It sounds like a really cool company. Like if a company does cloud computing, you know that they have a giant server and they are probably based in Silicon Valley and stuff like that. Cloud computing companies are storage companies. They're glorified storage companies. They have a giant hard drive rather than a small one on your desk, and they allow you internet access to it. Amazon did very well by building a massive one very early on, and it was a fantastic investment for Amazon early on. But Amazon know that other companies are getting into this space, and eventually what it's going to come down to is you basically have 1,000 companies providing identical products. So the only thing that's going to be available to you long term is creating more space for less money. Compare this to Alibaba. Alibaba are already in a few other countries. They have a much more ambitious goal to e-commerce, that they want to be able to deliver anything anywhere in the world within 72 hours. This is an awesome goal, and I can actually see, and you're seeing Taobao and Tmall advertised in the Euros for the first time this year, and so they are going to reach the West. These are companies that can come over here. There's a huge amount of growth potential in them, and the barrier to entry to compete with them is extremely high because they have a huge infrastructure investment that is not easy for other companies to come into. However, of course, there are other e-commerce companies, but they generally try and carve their own niche because competing with them directly would often mean that they start getting competed with. Basically, it leads to a war. So you don't want a price war. What you want is to have your own niche and to become a specialist in that niche. So I don't see a lot of competition for Alibaba in e-commerce. At least not for a very, very, very long time, especially with the investment in warehouses and infrastructure, because warehouses are now, they are more tech intensive than a cloud computing company, where a cloud computing company is just a server with access to internet. A warehouse has autonomous driving robots and all this sort of AI data as to where each of the parcels are and how best to collect them. They are way more techy than a cloud computing company. And so, yeah, I definitely think there is a huge barrier to entry to competing with Alibaba. And then it may not be as big as the moat that Baidu has, but then Alibaba has actual growth potential around the world and within their own corporate structure. Because if they grow into becoming the delivery part of the business, not just the online website, then they are going to be getting more margins and they're going to be getting more consumers. So yeah, Baidu, I'm really impressed. At times they've had better growth than Alibaba and they are more favorably priced and they do have better margins at the minute, but I just don't see them as being as exciting as Alibaba in the long term. And the thing is, some people might like to have both. I definitely think that's a worthy idea. But if you go check out my portfolio, 𝗙𝗙𝗖𝗋 on eToro, then you'll see that I am just holding Alibaba. This isn't financial advice. You should just do what you feel, but you've got to be skeptical of someone that says, this is good. Like, there's loads of other YouTubers probably talking about how good Baidu looks. But if you can't see their portfolio, just be really skeptical of them. I really hate it when people don't tell me your opinions, tell me your positions. That's what I'm interested in. Perhaps what Baidu should really do if they want to be rich is